In this video, I'm going to share with you the latest news about CapitaLand Ascendas REIT's property divestment and what it means for investors. Let's get into it. Hey friends, welcome back to the channel. I'm Iggy here, and I've been covering topics such as stocks, finance, CPF, and basically everything related to growing your wealth. The investing Iguana is featured and ranked 8th in the 2023 Influential Tigers by Tiger Brokers, with over 800,000 reads. I've also covered over 500 videos and over 250,000 watch hours as of September 2024. I also occasionally focus on topics related to the regional or world economy. Today, we're diving into some exciting news from CapitaLand Ascendas REIT, also known as CLAR. They've just announced a major property divestment that's caught my attention, and I think it's worth exploring what this means for investors and the REIT's overall strategy. Let's start with the basics. CLAR's manager has agreed to sell a property located at 21 Jalan Buroh in Singapore. Now, this isn't just any ordinary building. We're talking about a 3-story ramp-up warehouse with a 7-story ancillary office block. It's a substantial piece of real estate, and the sale price reflects that. The agreed sale price is $112.8 million. That's a pretty impressive figure, but what makes it even more interesting is how it compares to the property's history. CLAR originally bought this property back in 2006 for $58.4 million. So, we're looking at a sale price that's nearly double the original purchase price. That's a significant return on investment over the years. But wait, there's more. The sale price isn't just good compared to the original purchase price. It's also well above the current market value. CLAR had 2 independent valuations done on the property as of July 1st, and the average of those valuations came in at $67.5 million. So, they're selling the property for about 67% more than its estimated current market value. That's a pretty sweet deal if you ask me. Now, you might be wondering what CLAR plans to do with all this money. Well, after accounting for various costs associated with the sale, they're estimating net proceeds of about $102.9 million. That's a hefty sum that could be used for various purposes, such as paying down debt, funding new acquisitions, or improving existing properties in their portfolio. But what does this sale mean for CLAR's financial performance? Well, the good news is that it's not expected to have a significant impact on their net asset value, NAV, or distribution per unit, DPU, for the 2024 financial year. This suggests that the REIT's management has carefully considered the impact of this sale on their overall financial position. However, it's worth noting that there will be some minor effects on a pro forma basis. The net property income, NPI, would decrease by about $4.6 million, and the DPU would see a small decline of 0.085 cents. These are relatively small changes in the grand scheme of things, especially when you consider that CLAR's NPI for the 2023 financial year was a whopping $1.023 billion, with a DPU of 15.16 cents. One interesting aspect to consider is how this sale will affect CLAR's leverage. On a pro forma basis, their aggregate leverage would drop from 37.9% to 37.4%. This might seem like a small change, but in the world of REITs, every bit of leverage reduction can be beneficial, especially in a rising interest rate environment. Now, let's talk about timing. CLAR expects this deal to be completed within the fourth quarter of 2024. That's still a ways off, which gives them plenty of time to plan for the use of the proceeds and adjust their portfolio strategy accordingly. Speaking of portfolio strategy, it's worth taking a look at how this sale fits into CLAR's bigger picture. After this divestment, CLAR will still own an impressive 228 properties. That breaks down to 96 properties in Singapore, 34 in Australia, 48 in the US, and 50 in the UK and Europe. This diverse portfolio spread across multiple countries helps to mitigate risks and take advantage of different market conditions. So, what does all this mean for investors? Well, there are a few key takeaways. First, this sale demonstrates CLAR's ability to extract value from its properties. Selling an asset for nearly double its purchase price and well above its current market value is a clear win. Second, the minimal impact on NAV and DPU suggests that this sale is part of a well-thought-out strategy rather than a desperate move to raise cash. Third, the slight reduction in leverage could provide CLAR with more financial flexibility going forward, which could be particularly valuable in the current economic climate. Lastly, the fact that CLAR still maintains a large and diverse portfolio after this sale shows that they're not compromising their overall strategy for short-term gains. Of course, as with any investment decision, it's important to consider this news in the context of the broader market and your own investment goals. While this sale appears to be a positive move for CLAR, it's just one piece of the puzzle when it comes to evaluating the REITs as a whole. As always, I encourage you to do your own research and consider consulting with a financial advisor before making any investment decisions. The real estate market can be complex, and what works for one investor might not be the best strategy for another. In conclusion, CLAR's divestment of 21 Jalan Buroh appears to be a strategic move that capitalizes on the property's appreciation while maintaining the REIT's overall financial stability. It's a reminder of the importance of active management in the REIT sector and the potential for value creation through smart property transactions. If you guys enjoyed this video, then you're going to love my recent analysis on Parkway Life REITs. In that video, I break down why OCBC has given it a buy rating with a target price of $4.48. We dive into the fundamentals of healthcare REITs, explore Parkway Life's unique position in the market, and discuss why analysts are bullish on its prospects.